Well, of course, as we go into the new week, the intense focus is going to be back on Janet Yellen and the Federal Reserve. In terms of timings, well, if you're an Australian client, we're looking for that to come out at 4 o'clock in the morning on the 15th, Eastern Standard Time. Janet Yellen will then take to the stands in a press conference and question and answer time some 30 minutes later. If you're a UK client, that should come out around about 7 o'clock at night on the 14th. Now, in terms of assets or markets to look out for, certainly we're going to be keenly focused on the US fixed income market, whether or not we see a steepening or a flattening of the curve. Specifically, I want to have a look at the 5-year US Treasury, because that encompasses all these interest rates and economic projections going out for the next 5 years. So I think that's probably the key driver of things like the US dollar. So we want to be focused on the US dollar. Specifically dollar yen, I think, will be an interesting pair to watch. Probably that's going to be most sensitive to any kind of repricing of the market there. We want to have a look at some of the side effects that come from moves in there, such as what's happening in gold, what happens in the US banking space. Have a look at the XLF, the financial ETF there. And also have a look at real yields as well. I think that's going to be a key driver there. So, a lot of things to look out for in terms of the assets. In terms of what the smoking gun has been, well, I certainly think if you go back to the minutes in the prior statement that we saw back in May, well, they said as long as the data comes in as expected, then we should see a rise in the fund rate soon. And that key word is soon, and the market has extrapolated soon to be this coming meeting here. And if you look at market pricing, it's just over 90% probability. So it's pretty much a done deal. It's a certainty that the Fed will raise rates. So we're not betting or trading around this market event in terms of raising rates. The Federal Reserve have known market pricing is this high for some time. They've had every opportunity to push back and guide the market lower in terms of their expectations. And there's a reason why implied volatility in markets is so low. It's because we've got very predictable central bank moves of late. So I think the Fed have had every opportunity to guide the market lower. They haven't, and therefore they will raise rates at this meeting. And most people in the market suggest that's going to happen. What we're looking for most importantly is their view to market the economic data cycle. Now, we know that the US economic data has been below expectations of late. We saw in the first quarter a GDP print of 1.2%. We are expecting that to snap back to around 2.5%. And the Federal Reserve themselves have said that the soft patch has been transitory. So after all the things they've been seeing with the softness inflation that we've been seeing, will they still take this view that the economic growth numbers have been transitory? Now, when they give their economic projections around things like growth, inflation, and also the Fed funds projections, will these remain unchanged? I personally believe there's an opportunity for the Federal Reserve to take down their 2017 core PCE numbers from 1.9 down to 1.7%, down about 20 basis points or so. So that's going to be an interesting situation. Will they look at the soft data and still be as optimistic that we are going to see a rebound? If we do, I think the market will take that as a positive sign and probably start buying dollars and steepen the curve a little bit. If you look at financial conditions, they continue to become easier, and the Federal Reserve won't like that situation that they've been raising rates 50 basis points, but financial conditions continue to become more and more accommodative. They won't like the fact they're raising rates into a situation where the yield curve is falling and inflation expectations in the US are falling whilst financial conditions become more accommodative. We want to have a look at the balance sheet. The Federal Reserve have talked very openly in the minutes about normalising their balance sheet. The bonds that they've bought through the various quantitative easing cycles will run off. The proceeds will mature. Instead of reinvesting those into new assets and keeping that balance sheet consistent, we want to have a look at what they're going to say about that, because it does take away the need to raise the Fed funds rate going forward. So there's a number of factors that we want to look out for, but the market has become very pessimistic about future rate hikes going forward. And will that continue to be the case? The market and the Federal Reserve are on different disconnections, between the Federal Reserve being pretty optimistic and looking for 8 rate hikes over the next few years, where the market's only got 3. And that's the key situation that you want to look out for. Who is right and who is wrong? And I think that's where you're going to see the moves in markets. That disconnect needs to mean revert at some stage. One is right, one is wrong, and that's what's going to create moves in the US dollar.